Welcome back. We got a fresh round of data ahead of tomorrow's key jobs report. It was ISM services. A lot of headlines here also because the headline showed the fastest services growth in this country since February of last year and a big jump from the prior month. Meanwhile, good news as well for jobless claims, still around 225,000, although that level will soon be affected by Hurricane Helene and the ongoing strikes at the port and at Boeing. All of that said, stocks are lower today as this October choppiness continues. My next guest is buying the pullbacks, though. Joining us now is Paul Christopher, head of global investment strategy at Fargo Investment Institute. What do you make of the services data, Paul?
Yeah, the economy has been bifurcated for some time. Manufacturing has looked weak, and if you wanted to look for a recession case, that's it. Anyone who depends on bank lending and has had to suffer higher rates, they're really suffering. But the services sectors have done really well for the last couple of years. We think that's going to be the engine that propels this economy to a soft landing and then to a recovery that gathers strength as 25 develops.
The chatter that I'm hearing is that it's too strong. Not that people are doubtful that it's true, but that if it is true, do we have to start worrying about inflation again? And forget soft landing. Do we have to worry that the Fed perhaps doesn't cut at all like what we're expecting right now?
Well, there is a disconnect between the market expecting 2.5 percentage points of rate cuts and others on the street. But look, as the economy slows, and it is slowing, services will go with that. It won't be quite as strong as it is today, and that should help moderate inflation going into next year. What happens into the balance of 25? Yes, you're right. We do think inflation does pick up in the second half of next year amid that cycle, improving. That's why our rate cut forecast is only for 8 instead of the 10 that the market is calling for right now. That's just going to create a little bit of volatility for next year, but it doesn't really prevent us from right now starting to position for that recovery that we think will extend even beyond 25.
What's interesting to me is that as someone who thinks inflation could prove sticky, you still prefer large caps over small ones. Dan Suzuki also thinks inflation will be sticky, prefers small caps over large ones. Why do you think that that kind of macro is not one that would necessarily favor the Russell 2000?
Sticky is sort of a sticky word. If you think about 2.5% inflation, that's plenty enough for the Fed to continue cutting rates. If inflation were to stick around 3 or 3.5, that would be more serious, and then we'd be more concerned about small caps. But we're positioning right now. We're underweight small caps relative to large, but we're at strategic levels. In other words, we want investors to be at their long-term goals for small caps, getting ready for a recovery that we think will develop more quickly and more strongly, more forcefully than inflation will. And that's going to be, and it's typically a good environment for small caps. So we don't want to be underweight small caps here. You want to be at your strategic long-term goals.
Okay, so you're also looking at communication services, industrials, financials, materials, energy. That's kind of a very broad way to look at things. But if you had to boil it down, where would you say that you see the most opportunity for alpha relative to the consensus, either in specific stocks or sectors?
Yeah, because our view on inflation is maybe a little bit more sanguine than others going into the year, we would position more cyclically. In other words, position for the economy to recover early in 2025. Expect that to be the main story, and that explains the predominance of cyclical sectors, or that is sectors that should do well as the economy begins to recover. So industrials, materials, right, energy, and financials all should do well as the economy starts to recover.
Yeah, and then finally on Mag 7, and technology in general here, what do you do?
Yeah, technology has looked expensive to us for a while. We need to see much more of a pullback. We might get that considering all of the uncertainties that are swirling right now. The Middle East, you mentioned earlier, the strikes, the weather, the Hurricane Helene, and the damage that it did in the southeastern part of the country. Though those are all going to register some kind of hits, either to higher oil prices or to the economy directly. Then you've got the uncertainties around the election. There's always uncertainty around election time. And so on those sorts of pullbacks, a 5 to 7% pullback here would not be unusual. That might provide a good opportunity to buy those Mag 7, that information technology sector, at a more attractive price.
I see. All right. Sounds good. We'll see what the next few weeks bring. Paul, thanks for your time.
All right.